We love these bus trips. It's like 12 years. We try to go off the beaten path, and when we do them, we see clients. I'm about to have lunch, which you'll be at with 100, 150 clients of ours. We go to the branches. We get to talk to our people. On the bus, we sometimes have branch managers and loan officers and small business tellers, and we ask them, what can we do better? We give them immunity and beer. We actually want to know, and makes us a better company. We have a lot of fun. And then we do places we haven't been before. So we've been expanding in Montana, Idaho, Washington State, so we're in Spokane, Boise, and now in Bozeman. It's just fun to do and a great time. We learn a lot.
What have you learned so far this year?
Okay, so this is for folks on CNBC. Leave California and New York, come visit Montana and Idaho, and you know what? America is alive and well. The innovation is unbelievable. The people get along. It's not all about the polarization you read about. The innovation is everywhere. People think Silicon Valley, but I met with a company here called Bridger Photonics, run by Peter Roos and all, that does monitoring of methane gas, and they're doing a lot of work with all the big oil companies about how to improve their emissions and stuff like that. It's extraordinary, and it's built here. Gibson guitars are now built here. I met Interstate Cargo in Boise, and they built a whole big business, a Russian immigrant. That's America. We should be applauding the beauty of America and all the things that it does, and free enterprise.
Well, let's talk more about America, because Fitch, big news today obviously is the downgrade of U.S. debt down to AA+. Yeah. What's your take on that decision?
Yeah, I'll give you a couple of quick things. It doesn't really matter that much. The markets decide. It's not the rating agencies who make these big decisions. Number two, they point out some issues which we all knew about our debt ceiling crisis and things like that. But number three, most important, the American public, this is the most prosperous nation on the planet. It's still the most prosperous nation on the planet. It's the most secure nation on the planet. And I would point out to the rating agency, I could, that there are a bunch of countries rated higher than us, like AAA, but they live under the American enterprise military system. To have them be AAA and not America is kind of ridiculous.
These are countries like Canada and others.
Yes.
In terms of the actual decision making behind the downgrade, it had a lot to do with political brinksmanship surrounding the debt ceiling debacle, the deficit itself. I mean, do you agree with any of those?
Look, those are issues. This is the most prosperous nation on the planet, North America. We have the Atlantic and the Pacific, the best military, the best economy the world's ever seen, the most innovation. The credit is sound. It should be the highest rated credit in the world. And yes, there are issues about, they're being raised publicly. I agree with that. We should get rid of the debt ceiling.
We should get rid of the debt ceiling.
We should get rid of it. It's used by both parties, and it's always used in a way that makes it very difficult. We need certainty in the world, and we should have more of it.
Let's talk about your thoughts on the economy, because you've been conservative with your balance sheet for a while now. You said that a year ago, actually last June, at a financial conference, that the firm was bracing itself for a hurricane, and then you noted that could be a minor one or Superstorm Sandy, and then you later downgraded that threat to storm cloud. So, what's your macro meteorology telling you right now?
Yeah, I actually did not downgrade it. I just simply use different phraseology that gets overtreated. So again, the big picture of America is resilient, unbelievable, et cetera. And we have today is a little bit of an anomaly. A very strong consumer, low unemployment. We're growing as a country. Still innovation. The consumer still has more money in their income, in their checking accounts they had pre-COVID. Their home price has gone for 15 years. Asset price has gone for 15 years. It's pretty good. Even if we go into recession, they're going in with a very good balance sheet, not a bad one, and businesses are in good shape. That's the good part. The storm cloud part is still there, which is things, I'm not worried. When I see people always talking about they're worried about this and they're worried about that, I don't worry that much. You can get worried about just about anything you want. I think people do too much of that, and I agree with Warren Buffett about the resiliency of America. But there are two things out there which give me heightened concern. One is the fiscal spending and the quantitative tightening. We've never had quantitative tightening. And I do think that might bite at one point, and I'm not, don't want to be surprised about it. And the second is Ukraine. The humanitarian crisis in Ukraine is extraordinary. The impact on oil and gas and food and migration. It could expand. Its nuclear proliferation, its nuclear blackmail. This is serious stuff which we have not really faced since World War II. So I put that in the cautious category. Hopefully that'll all sort out and the world will be safe again. But I hope people learn the world's not that safe. It will never be that safe, and we have to be very, very careful how we do that. And so how that affects the economy is different. But they are out there, and and the consumer is spending their money down. So I don't know if we have a soft landing, a medium landing, or a hard landing. I'm actually much more concerned about this geopolitical stuff all things being equal.
And of course, you mentioned QT as well.
Yeah.
You've said previously at Investor Day that everyone should be prepared for rates as high as 7%.
Yeah.
And there's a narrative out there that June's softer than expected CPI print is indicative of, kind of this mission accomplished, we're all good, inflation's under control.
Yeah.
Do you agree with that narrative?
No, I think people overlook at short-term data. All that, if you actually dig into the data, you probably wouldn't pay much credence to it. And so it goes up, it goes down. I think you got to look at a little bit more. And when I'm saying 7%, I'm not saying it's going to happen. I'm saying as a business person, there are reasons why it might happen, and you should be prepared for it. You never want to be in a position and say, I didn't expect oil to go to 120 or 30 or interest rates go up 500 basis points, and therefore I'm bankrupt. We should all be prepared for those type of things, but there's been a sea change in capital flows around the world. Governments have to sell more debt than ever before. All governments, including the United States. Now, some say less than down deficits. They're not down from pre-COVID. Debt levels are very high. They're selling more debt. Interest rates have gone up. Central banks are selling. They were big buyers. Now they have to sell for QT. We've never had QT before. And then also this new economy of ours, the green economy, $4 trillion a year. IRA, CHIPS Act, militaries around the world, almost every country is beefing up its military a little bit. These things may be a sea change in what you're seeing about capital demand. And I think there's a good chance that you guys, in 6 months and 9 months, are going to be talking about crowding out. And so we'll find out. The 10-year bond just went to 4.10. I think it could easily go to 5%. I'm just saying people should be prepared for it. Don't be afraid of it. Just be prepared for it.
How do you see that net playing out? Because you mentioned the fiscal spending side of it, and then that's concurrent with QT. So they're kind of running counter to each other.
They are. Yeah, there are contradictions in raising short rates. We still have a lot of liquidity. They're taking the liquidity out. But the curve, a natural curve one day might be 3.5 on the short end and 5 in the 10-year end, and that's maybe where we're going. So what it leads to in the short-run economy, I don't know. I think some of these things can have real problems down the road if we don't deal with them today. You're really better off dealing with them today than just letting them get worse over time.
But to your point, the consumer has been more resilient than expected. Some of that
but more because we spent $5 trillion over the 2 years of COVID.
Right.
That is extraordinary money that went to the hands of consumers and small businesses. So the government did the right thing to get us out of this terrible COVID. Remember, unemployment went from 4% to 15%, and I remember like 3 months. But we continue spending and we continue QE for too long, and we're paying the price for that, and hopefully it won't be too big a price.
What do you think the price?
Well,
will
I said
be?
it'll be higher interest rates, and I don't know what's going to do to the economy.
In terms of the consumer, do you think they fully absorbed that stimulus yet and absorbed the period of low interest rates we've seen for so long? Will we ultimately start to see the effect of that, when the tide rolls in?
Yeah, that's what I'm talking about, the storm clouds down the road, or, fiscal spending, QT, higher rates. We haven't had the full effect of that yet. I don't know what that's going to do. I don't want to guess about it. I don't know, and I think when people spend their time forecasting the TV, they're mostly wasting their time.
Do you think the Fed's done a good job?
I think they did a good job early on. I think it's quite obvious there was too much. It wasn't just their job, fiscal spending and monetary spending. I think they took too long. They've kind of said that. They caught up by going to 5%. They made sense to, pause for a while. We're going to see. They may have to go a little higher. I don't know, but they've caught up. I have enormous respect for Jay Powell.
Let's talk about the Fed in terms of regulation. Because last week we saw the Basel III endgame, Basel IV, some people call it increasing capital standards for especially the largest banks.
Is there some way someone can actually quiet that group down over there? Okay, yeah, sorry.
Is that a metaphor for?
What? I don't know. Maybe we can. So
higher capital requirements for you all. What do you think is the overall impact from these new rules that have been proposed?
First of all, I just want to be blunt. It's hugely disappointing. I think these rules are I've always thought G-SIFI was a joke. Now we have operational risk capital, which I think is equally bad based on models which kind of make no sense to me. And if I was the Fed, I'd be very careful about saying their models are perfect. Remember, their models didn't show inflation and they didn't show 5% interest rates and stuff like that. They lack transparency. I don't know what they want the outcome to be, but I think they should be saying, here's what we want the outcome to be. And it can't be just safe for banks. We have the best financial system in the world. I don't think there's a lot of calibration among, we have hundreds of rules. Lots of, very little calibration among the rules. And it can have a real effect on if they want to push all mortgages and all small business banking at banks, so be it. They should tell the American public that. And so and it'll have real effect on consumers. So I'm going to say just mortgages. The way that I've read it so far, and more detail to come, it's going to make it much harder to make a small mortgage and a mortgage to a lower FICO person. And I just think that's a huge mistake from a policy point. Now, if that's what they want it to be, so be it. But they should tell the American public that when we do this, it's going to reduce mortgage affordability and raise the cost by X dollars, because that is exactly what it's going to do. And I can say the same thing about small business and a bunch of other impacts. So we're going to adjust to it. I'm not sure it's the right thing for America. And we're still reading all the details. It's 1,000 pages long. I also want to point out it's 10 years after the crisis. So this has been going on for a long time. We need certainty, policy. The stress test clearly didn't work. So we do 100 a week. They do 1, and they act like that's the real stress for the company. I'm far more worried about China and cyber than I am about that stress test. And I just think, and the other thing, we don't have many conversations with them anymore. We should be having conversations with our regulators about what we're worried about, what they're worried about. There's almost none of that. So it's both lack of transparency and lack of conversation with real practitioners. A lot of people in ivory towers, a lot of opinions here, they've never been in the real world. I'd like to see them get in the boxing ring one day.
Well, speaking of the recent banking turmoil, you said in your letter to shareholders in early April, quote, "The current crisis is not yet over, and even when it is behind us, there will be repercussions from it for years to come."
Yeah.
Do you think that these new regulations solve for that?
No. I think they're, to some of these folks, to hammer everything's a nail, that's what this is. A lot of these folks are using every issue that takes place to justify what they already thought. The best advice I ever heard was use your brains to figure out the truth, not to justify what you already think. So, look, this will sort out. JPMorgan will be fine. I don't think it's the way to run a railroad, but we have no choice. They do it. But it's also being cost-benefit analysis. They're required to do that. They're also required to adjust things for the size of the economy, the size of the banking, and none of that took place. So none of this calibration. And so I wish we did it. I think we'd have a healthier banking system. I thought Dodd-Frank accomplished a lot of stuff. I think this is way beyond that.
What do you think are the repercussions from the banking crisis? Because there are reports out there that you all were directly involved in the Bank of California PacWest deal that was announced last week. You personally received regular briefings as it came together, according to those reports. You advised Bank of California in what some have called the rescue takeover of PacWest. You're buying about $2 billion of mortgages to facilitate the deal. Placement agent for $400 million worth of private equity infusion here. Is this the playbook now for potential stress that could arise?
No, I called it a mini crisis. Only so many banks were offsides on interest rate exposure. Remember, some of these things were incented by accounting, incented by regulators, and we were not completely aware of how quickly deposits could leave someone like Silicon Valley Bank or First Republic. That didn't happen anywhere. So we were quite clear. We thought First Republic was the last domino. A few others may sort out. PacWest, thank God, it's good for them. I'm glad they did a public type of transaction. So it's over for now. All the banks, we're the biggest bank to community banks and regional banks. I support all of them. And they reported the first quarter, they reported the second. Most of them did okay. They didn't have runs in the bank. They earned money. They've got plenty of capital. They're preparing, it looks like, for maybe potentially higher rates or maybe higher real estate laws, something like that. But it's a sound system. You're going to have failure. We shouldn't act like every failure is a failure of the whole system. But we should learn from every failure. And I think there are a lot of things we could have learned and done differently, and they're not in the new regs. There's something that should have been done slightly differently in other maybe potential requirements.
Well, they did, lower the threshold to those with $100 billion or more in assets, which would probably be more along the lines of a mid-sized bank.
Yeah, I'm not sure that would have made any difference to Silicon Valley Bank, but
you don't think so?
I don't think so.
What would have made a difference, do you think?
That you don't just stress one thing, but you stress multiple things, and that you look at other things that you create liquidity. Like liquidity is created in so many ways. Like we have so much liquidity, but when things get bad, I cannot use it because of current rules. I think there are ways that things can be set up, and I won't bore you all with credit facilities and stuff like that. Credit facilities with the with the FHLB or the Federal Reserve, something like that, where every bank actually has all the liquidity they need to back up a major run in their bank. And so there are things to fix it. They are not in these new rules.
And obviously the funding costs are higher when you do see some sort of run, and so margins for the industry are under pressure as well.
Yeah, but some of that is just
temporary.
some of that's just people have to pass on more of the the earnings to their customers. That's a normal thing. That isn't because of the crisis.
I see.
Right.
You mentioned First Republic, and part of this bus tour is actually,
Yep.
meeting different First Republic legacy places. How's the integration going?
Excellent. Jen Peepsack and Jen Roberts and Marianne Lake are doing it. They have thousands of people working on it. But here's the most important thing. They did a lot of great stuff. When we were just all over Bozeman and all over the place, a lot of great customers. They did some things very well. We want to incorporate that in how we do things. But the integration itself, you have to get systems, technology, risk, legal, audit compliance, branches. I am going to a branch later today, First Republic branch. They've got some great people, and we were able to assimilate it, help the people, save a lot of jobs, and hedge literally within 2 days or 3 days all the interest rate exposure. So we didn't add any to our balance sheet by doing that, and so the system is safer. We save those jobs, and hopefully we're going to do a great job for the clients.
Do you have an appetite to do any more deals?
Not really. I mean, they don't want us to, which I think is fine. They don't want big banks to do other deals to make them bigger, which I think is fine. If you said, again, this goes back to they set regulations, but I also don't think that the FDIC, the public should know we pay for the FDIC. It's a mutual insurance thing. So Silicon Valley Bank is probably going to cost us $2.5 to $3 billion. And so I don't want whatever happens when the next bank comes bid in. I want to make sure that bid is a reasonable bid and not where $10 billion extra is being given to a small bank. That is not fair to anybody else. So I think they need to set up clear rules about how you want to do resolution and recovery. And I also think we made huge mistakes on Silicon Valley Bank. And I hope the regulators are going to be looking at that one day. What went place? We created a crisis and we created a melting cube that maybe didn't have to happen.
What do you think needs to be assessed from a regulatory standpoint there?
I'm not going to go through it now, but they should be asking a lot of questions of themselves. Like whenever we make a mistake, we spend a lot of time on what I call the after-action report, the post-mortem. What did we do wrong? What can we do better? How do we make sure we're doing that across our company? We know we're going to make mistakes. So I don't think we should treat every mistake like it's a violation of morality or something like that. But I think they should be doing a little bit of that, a little soul searching. Do
you think there is an appetite among regulators and an appetite among the C-suite to do more consolidation in the industry?
I think some companies need to. And I think, again, I hear, consolidation, et cetera. It's a dynamic system. It's not a static system. They say there's 4,000, they merge, they're all getting bigger. There are a lot of big companies that have gotten smaller because they didn't do a good job. There are a lot of new companies, Marcus, Ally Bank, PayPal, Apple, basically is a bank today. There are a lot of startups. I just drove by a bank, that here, I'm sure it's a startup bank. And some middle-sized banks and small banks want to merge because they can do a better job for their customers or diversify their base more. It's a dynamic system. Let it happen. And it's a great system. America has the best financial system in the world. And the other thing I should say about regulations is, and I really do mean this, hedge funds and private equity are dancing in the streets because they're just going to pick up a lot of business because of this. But we do have the best system in the world, including private equity, hedge funds, venture capital, middle market companies. It's extraordinary. That strength is part of the strength of America. And part of what America free enterprise is the most important part. It's not the money, it's the people. It's people starting things and growing things and moving places and having dreams and being allowed to further those dreams, which has risk. Sometimes you make a loan has risk. We want to make some risky loans. We want to help Bridger Photonics accomplish our goals and serve their clients. And yeah, sometimes we make a mistake or something like that. Though I think that's a great company. I'm not referring to them. So.
Well, what kind of music do you think they're going to be dancing to? Because that is the big criticism of increasing capital requirements is that it's going to send business to the non-bank financials, the unregulated sector of the economy.
Yeah, so that's not always bad. I'm not against competition, but the mortgage business is now 80% outside of banks. Okay, and that, I don't know what it's going to do with the rest of that. It makes it hard to do small business loans. It makes it hard to do some risky loans. And obviously, a lot of that's going to go to the non-banking system. That may not be all bad, but again, people should be analyzing the consequences and saying, we want that to happen because it's better for America and the citizens of America. I've never heard that statement. I think a lot of these things are done without any forethought about the ultimate consequences and very little calibration. We really need to be very thought about how we're doing things. So, the banking system's been, this has been going on now for 15 years. And maybe we should take a deep breath and analyze and think about it. If you look at our regulatory system, it's not just, I have this chart, I don't want to have it. I was going to show it to, can you hand it to me? Thank you.
Thank you, Judy.
I made this chart and people made fun of me about our regulatory systems for banks. And I don't know if you can see that up close. There are so many people involved. There's cross responsibilities. No one's really responsible. And I'm not showing this because of banks. I'm showing this because we're doing this for building bridges, opening schools, building roads, starting companies, starting small businesses. We shouldn't be crippling America with stuff. We don't recalibrate regulations all the time. What we really should be doing is, what's the best thing that works? Acknowledging flaws, making modifications. We don't do it. And I believe that some of this stuff has slowed down the growth of America. I wrote in my chairman's letter, for 20 years we've grown at 1.7%. Had we grown at 3%, which is definitely what we can get done, we'd have 15,000 more per person GDP, which, by the way, is the GDP per person of China. Ours is 80, theirs is 15. We would have been 95 today had we done stuff. I think this stuff has really slowed it down. Bad policy making, bad regulations, thoughtless type of stuff. It's easy to just pile more stuff on people. George McGovern, the most liberal guy who ever ran for president, wrote an op-ed, I think, in the Wall Street Journal after he ran for president, after he was a senator. He bought a small inn somewhere, and I think it was entitled, "If I'd Only Known How Much These Things Hurt My Ability to do business." He spoke about OSHA and litigation and the ability to hire kids and all these things. Maybe a bunch of people should ask that question. What do I need to know to understand the impact of these things on America? And the reason you want to grow America is because it is the foundation of helping our lower paid citizens too. And so I think we should do a better job taking care of lower paid individuals. I would double the earned income tax credit, but a healthy economy is the foundation of everything, including a stronger military. And so I think we got to spend a little more time about how do we grow the economy and make it better for everybody. And unfortunately, there are a lot of policy issues in D.C. People look at JPMorgan Chase. We're not the reason that inner city schools are failing. And I think people should be a little more thoughtful about what they actually want to accomplish and how you can lift up. So I think if you fix inner city schools, and by that I mean kids should graduate with a livelihood, paying $55,000 a year, I think that's doable. If you do that, change the earned tax credit, I would tax carried interest too, you can fix America. And that's exactly what we should be doing.
I think some people wonder, is policymaker Jamie in the cards for the future?
No. I think companies should be involved in policy making. So we do a lot of things to lift up society, which I'm very, very proud of. But getting policy right in D.C. is more important than individual corporate efforts. And so if you say education, immigration, regulation, health care, affordable housing, mortgages, if we get those policies right, that'll lift up society far more than any one company can possibly do.
What about the deal environment? We talked a bit about consolidation. What about the overall picture for deal making right now? Are you seeing any green shoots on that front?
Yes, but I could care less about that. Those things they're like accordions. They open and close. For sentiment, people, opportunities, regulations, FTC, it'll be fine in the long run. Companies will find a million ways to grow and expand and do deals. And yes, it's getting better today than it was 6 months ago, but we don't run the company that way. We run the company, we know there's going to be bad weather. We know there's going to be mild recessions, hard recessions. I call that the weather. We try to run the company that we serve those clients over there day in and day out, regardless of the weather. We want to be a fortress for you, and including NBC Universal and Comcast. That's what we try to do. Earnings go up and down.
I have to ask you, because there have been some headlines recently regarding Jeffrey Epstein and the ongoing litigation there. Has it impacted your brand equity at all?
A little bit sometimes, but we banked Jeffrey Epstein, and I'm so sorry that we did it. I wish we hadn't. Had we known then, we know today, we obviously wouldn't have. And so...
have you changed the vetting of potential clients?
Yes, because we have to be very careful. You can't kick out people based on allegations. So, but yes, I think we can do more, particularly around a whole bunch of things. And I think the banking system, by the way, sets the highest standards of know your customer, AML, protecting people. And yes, we make terrible mistakes sometimes, and we apologize for it.
I want to ask you about artificial intelligence, because going back to that letter, you said you already have 300 use cases in production today for the firm. And your chief information officer, Lori Beer, said AI delivered over $320 million in benefit through personalization and deepening client relationships. Are you positive about this technology? Are you worried about some of the unintended consequences that could arise from such a powerful technology? Yeah,
so first of all, we've put a person on the management committee, appointed Daniel Pinto and me, who does data analytics and ML. That's how important we think it is. It is a game changer. Now, it doesn't mean it's going to change it tomorrow. It may take a while to build in, and it can do wonderful things. And we also, just so that your public knows, we have an AI ethics department, and AI explain. We have to explain it to regulators, political leaders, and stuff like that, in addition to running 300 programs. And there's machine learning, there's AI, there's large language models. We kind of do all of those various things. It is a game changer. And yes, it needs to be done right. And it's going to be hard to regulate. I do worry about it because bad guys are going to use it too. You've had people like Henry Kissinger and Eric Schmidt, who I have deep respect for, worrying about if it's ever used in military, it can lose control. But so yeah, there could be downsides. But remember, there were downsides to cars, pharmaceuticals, airplanes. But you live a lot longer. You have a far better life. And the other thing I think in society, people. We went from working 6.5 days a week 60, 70 years ago to 5 now. My view is in 30 years, your kids will probably be working 3.5 days a week. They'll probably live to 100, and they probably won't have cancer. Those are good. So technology drives all that. That's fabulous. If it causes too much, job loss and stuff like that, then we, society, can step in with relocation, retraining, income assistance, all those various things. So there are a lot of solutions, again, if we get policy right.
If we get policy right.
Yeah.
Jamie Dimon, thank you so much for sitting down. Wide-ranging discussion today, an important day for the markets, the economy, the banking industry as a whole. We really appreciate it.
Thank you. Everyone out there, keep the faith in this wonderful country of ours. Support free enterprise. Thank you.
Thanks, Jamie. Kelly Elson,